Hey guys, we're looking to get you started and talk to you about what money is and how money is used to go through, but specifically how banks use money. So we're going to talk about the banking today and how economists use the money supply, what services banks provide, how to make banks to make profit, or how do banks make profit, and what are different types of financial institutions. Also electronic banking and how it's affected us as well. So to understand that, first of all, you have to understand M1. M1 consists of assets that have liquidity, or the ability to be used. So think about it as like cash. You can spend it anywhere. It's good. You don't have to wait for somebody to do this. It's not like a check where you have to wait for it to clear. Cash works anytime. So, or something that's as easily as cash, such as debit cards. Debit cards can spend right away. Even traveler's checks would count because you've already used the cash for that. So all those are components that would make up M1 when you come to talk about the money supply. The next one would be called M2. M2 consists of all the assets in M1 plus your savings account, mutual funds, things that you can't spend right away, but they do still count toward your money supply because it is still your money and you can get it eventually. A money market mutual fund also is a pool of money that investors use as well. So all of this creates our money supply, and money supply is all the money available to the U.S. in our economy. Now, that being said, banks obviously hold most of the world's money, but they have multiple functions aside from just holding money. One, obviously, as I just mentioned, storing money. Banks provide a safe, convenient place to store the money. It used to be in history originally they weren't safe. Matter of fact, banks sometimes would close up and leave, or there were times where banks would run out of money if there was a scare, and then you would lose your money because they didn't have any because they loaned it out. Today, it's a lot more safe. We have FDIC, which insures it. Also, we have credit cards. Credit cards are, as we talked about before, they're loans. So you're actually getting a loan from the bank. Also saving money. Now, saving money can happen in a couple different ways. One, there's obviously savings account. A saving account is a good way to save money for emergencies, but it's not really a great way to save money for actually making money. When people think that they put their money in savings account, that they're going to make a lot of money, and really they're losing money because the interest rate that you receive on the money is actually lower than normally the inflation rate. So in a sense, your money is really worth less if that's how you're really saving your money. Obviously, they save your money in checking accounts, but that's just for immediate use and you don't make any money on that. The reason why savings accounts will make you money, though, is because they will loan your money out, and that's how they make money on it. There's also money market accounts. These are accounts that are used to transfer your money into mutual funds and various other long-term deals. And then certificate of deposit, it's also known as CDs. Think of a CD as a savings account on steroids. It's basically you put that money in there for a long period of time. You have to leave it in there for say 5 years, but you have a higher interest rate. There is a penalty if you were to take it out, but because of that, that's why they pay you more. Again, then there's also small business loans, mortgages, and various ways in which banks do so. And that's how they also make their money, because they make it on the interest rate that you pay them back. And mortgages, as a specific one, is a specific real estate loan. Normally you get a lot lower interest rate on mortgages. So how do banks make money? First of all, as you see, deposits from customers all comes into the bank. So we put our money into the bank. Then the bank goes and actually gives our money to customers. Customers then pay interest. So that bank is making more money on that interest. Also, they have fees and that they spend. But think about it. If you borrow $1,000 and you pay 10%, the bank now gets $100. And so now the bank has $1,100 that it can use when you pay everything back. Now, also the bank does pay you money, obviously on your savings account, but in general it's going to make more than it's going to lose, especially when you think about mortgages or other various loans that they give out. So in general, you give the money to the bank, they loan it out. Now, keep in mind, I want to make it clear, they don't loan out all of your money. They only loan out a small percentage. As a matter of fact, the government says that there's a limit that they can give out. Also, I want you to realize that with the bank in its loans, they have to make sure, they have to be smart with who they're loaning it out to. That's why you have to go through the whole process of making sure you have the money to do so. Now, there are a bunch of different types of banks. Commercial banks are for checking services, savings and loan associations, or chartered to lend money to home building. Saving banks traditionally to help people with smaller deposits. Credit unions are normally with associations such as you've seen the teacher associations, or just financial companies which deal with installment loans. Today, though, we have a lot of banking has changed forever. When I was growing up, we had a one little machine that you could go to take money out, or you pretty much had to go to the bank. I got my first loans from the bank. I've got I used to have to deposit all my checks at the bank. Whereas now, obviously, we use ATMs all the time. We can deposit everything, or even better, we can use our cell phones, which you don't even see on here. Obviously, we have debit cards, which you can spend money right away. That didn't exist. You had an ATM card, and that was it when I was growing up. So things have changed dramatically when it comes to the use of that. ACH clearinghouses, which transfer fund from account to account, or home banking. I mean, I bet most of us now check everything online. Most of us will use our phones to transfer money or to send money. Even with things such as Venmo, or PayPal, we're able to take account cards. And obviously, with the magnetic strips, and what you notice we don't even have on here are the chips that we have. It says computer chips, but that was actually just as account balance. Now the chip actually does everything for us. So electronic banking has changed everything when it comes to banking. All right. I want you to go ahead and answer these questions. Number one, the money supply of the United States is made up of which of the following? And number two, why are the funds in the checking account are called demand deposits? All right. Go ahead and pause me for a second, and then I want you to press play. All right, as you can see, it's number one is all the money made up and available in the economy. So that's M1 plus M2. And the answer for number two is they are available whenever depositors demand them by writing checks. All right, good luck, and when you get a chance, I want you to go ahead and watch the next lecture. Thank you.